Good afternoon, everyone. Welcome to the first in a series of Vincents Insurance Services online presentations that are designed to assist you in your practice. My name is Mark Thompson, and today I have with me Kain Elsmore.
Hi.
You should be able to tell us apart by our voices. Kain being from Blackpool, and I'm being from Brunswick Heads. So the format of today will be a discussion, in essence, between Kain and myself about the top 10 things for plaintiff and defendant lawyers to look out for in relation to the assessment of economic loss for both employed and self-employed claimants. Proposed to conduct it basically as a discussion between Kain and myself. The opportunity to ask questions online is available. If you'd like to send questions, if we don't get time to speak to those questions today, we will certainly respond to you in due course. So, getting straight into what are the top 10 things to consider in relation to an employed claimant, we've broken that down into a number of different headings. As you see, the first one here is type of earnings. Then you'll see over base earnings on this first slide. But really, the fundamental thing to consider in relation to employed claimants is understanding exactly how they might get paid. And I'll let Kain speak to you a little bit about the idea of commissions and annual salaries.
So, as Mark mentioned, the first two slides really deal with this idea of getting a handle on what someone's being paid as an employee. The first tip is to think about how the earnings are derived. So, is the claimant employed on an hourly rate or as paid an annual salary, or perhaps they receive a retainer and commissions on top? An example of that might be in the real estate industry, where people generally receive a set wage and then commissions on the sales that they make. So it's just getting that handle on how they're paid. The second tip is about over-base earnings. So trying to understand if, in addition to any base amounts, there's amounts received in relation to overtime, shift penalties, bonuses, that sort of thing, and whether those types of additional over-base amounts will be available in the future, and also whether those over-base amounts have a superannuation component attached to them.
So that superannuation question is fairly important because there are some occupations where the over-base payments, overtime, shift penalties are included in the definition of superannuationable earnings, and there are some where it isn't. So you could have a situation where someone's earnings were $50,000 a year on a base salary basis, and then more like $100,000 after you added all the over-base payments. Now, ordinarily, the calculation of superannuation without any further guidance would be calculated on the $100,000 a year, where in fact superannuation may only apply to the first 50. So it's just really getting an idea of what does comprise your claimant's earnings. Now, one of the other things that's quite often missed in relation to employees, and the general proposition is that you don't need any expert evidence in relation to employees, but that can sometimes leave your claimants a little bit short in terms of what they're really earning. So if they receive benefits that aren't in the nature of normal salary, things like food and accommodation for people working in the mining industry, company vehicles for people who are working in sales roles, and mobile phones for just about everyone now, those benefits have a real value to the employee insofar as they alleviate the need for the employee to spend their own money. So while they may not be an inflow of cash, they're a reduction in an outflow. So they have the same real value to an employee. The next thing that Kain's going to touch upon is the time performance-based progressions within industries.
Again, getting back to the idea of getting a handle on the employee's earnings, it's really understanding how progressions and promotions may come about. Obviously, in the public service and industries where agreements are relevant, those progressions are generally based on different pay points in the agreement, whereas in the private sector, generally increases are based on performance and tenure and business need rather than straightforward time-based increases. So
fundamentally, what this first part of the discussion is about is enabling you to understand how your people are paid, how your claimants are paid. The second part of it is really a little bit more detailed about how some arrangements affect the payments, the total value of payments received by employed claimants. That top line there, comparable employee data, is not used as often as it should be. You see someone who's injured in a particular role where overtime and those over base earnings are an important component of the total earnings package. One of the best places is to go is to the employer, assuming the employer is willing to share the information, and in certain circumstances they can be compelled to share that information, to get an idea of what someone else who works in the same role has been able to earn since the accident. So you could have an argument that proceeds along the lines that because of the injury, the plaintiff or the claimant has been unable to work the level of overtime that's available. Now, one basis for that calculation might be the level of overtime that was available historically, but in industries where there are movements and spikes in overtime and over base payments, where there are big projects on and the like, it's preferable to go and get some comparable employee data, because that tells you exactly what overtime was available in that particular industry and that particular employer. Now, the only thing to be conscious of there is if there are a small number of employees in a particular industry or a particular employer, the fact that one of the residual employees' overtime has increased may be, in fact, a result of the absence of the person who's injured. So you need to be conscious of that when you try and draw conclusions from the comparable data. The second point in this slide here is salary sacrificing arrangements. Now, you'd all be aware of what that means. You take part of your taxable salary and divert it to some other form of earning.
There's an example of that on the next slide. You'll see where we talk about a benevolent employer, so a church or the like. Now, an employee there, I'll give an example of what their earnings might be. Their tax return details a salary of $20,000 per year before tax. But in addition to that, they have access to fringe benefits, or the ability to salary sacrifice expense payments to the value of 30 grand grossed up. And in addition to that, they've also salary sacrificed to superannuation amount of $5,000 per year. Now, the next slide will actually show you how that that scenario presents itself in an actual after-tax in your pocket situation. So after deducting tax from the salary, it's about $19,000. Add back the value of the salary sacrifice superannuation after deducting contributions tax of 15%. And then add on to that the value of the expense payments, which is an in-your-hand value of $16,000 after tax, brings you to a total actual after-tax earnings level of just a little over $40,000. Now, that is more than 100% higher than the original amount of $20,000 that you would have seen in the tax return.
So what that means is if you'd just taken the tax return and said, well, look, person's injured, can't work for 5 years, you'd say, well, the loss would be 5 times $19,000 before any allowance for discounting, where in fact the loss would be more akin to 5 times $40,000. So those types of things can make big differences to the amounts that you claim in the first instance. Now, you might think a benevolent employer is might be a fairly rare breed of employer, but things like the Red Cross, the RSPCA, and those types of employers all meet those fundamental criteria. Now, the other big employer who takes advantage of these concessional fringe benefits tax arrangements are public hospitals. So almost every nurse that I've seen records for in the last 10 years takes advantage of a slightly lower level of salary sacrificing benefit, but much more common nurses than employees of the RSPCA or the Red Cross. So just be aware that if you do see a nurse, you've got an injured nurse as a claimant, then look at the tax return. You'll see in one of the disclosure items an item called reportable fringe benefits. Now, that's the giveaway that someone's salary doesn't comprise all of their earnings. So it's something that you need to be aware of, particularly in relation to nurses and employees of benevolent institutions. The other one that, in fact, a matter I'm working on currently is a Minister of Religion, and they have specific rules that relate to their earnings such that they can essentially receive all their earnings by way of salary sacrifice to fringe benefits. So they pay, in certain circumstances, have a salary of $5,000 and have a real employee package upwards of $60,000, $70,000. So you just need to be really careful that for some of those industries, and you don't miss that salary sacrifice part of it. If you do have a Minister of Religion as a client, and unluckily they get injured sometimes, they don't even have to report their fringe benefits. So there's no reportable fringe benefits in their tax return because they're completely exempt from the fringe benefits tax rules.
The next thing we're going to look at is industry-specific type issues, something to consider in relation to different industries such as construction and mining. You've got to think about activity. So looking at perhaps building approvals in the area in which the claimant works, or the value of construction in that area. And whilst you can't apply the same trends exactly to the claimant's earnings, it gives you an idea of how much work has been available to the whole industry. Another issue that we see a lot of is in relation to real estate agents. So generally there's quite a large lag between work being completed by a real estate agent and actually receiving the income in relation to that work. And also with that industry particularly, there tends to be the issue as to whether the level of work they actually contribute drives the level of income that they derive. Also economic, political impacts on industries, specific industries.
So if I could just touch on that, the mining industry particularly, and it used to be, the proposition used to be that every young person who was injured was about to head out to the mining industry and make a lot of money as a machine operator or a truck driver. So that's certainly become less attractive because of the massive slowdown in the mining industry of recent times. Not to say that every mining worker is affected in the same way as every other mining worker, because you've got a situation where you've got someone who's been in the mining industry for a significant period of time and they're injured. To apply a general downturn in the mining industry to their particular earnings can be punitive in certain circumstances, because if there are, if the amount of activity in the mining industry halves, it doesn't mean that the number of them, that each employee within the industry halves their earnings. It might be the number of employees halve, and in fact, if there were 10 employees, 5 of them will earn nothing, and the top 5 will still earn exactly what they earned prior to the downturn in industry. It's just being conscious of the fact that you don't apply broad statistics to individual earning circumstances, and that's equally applies to the construction industry and the real estate industry to a large extent because of the way in which that market fluctuates. And the other really interesting one at the moment is the way that taxi drivers are earning at the moment with the introduction of Uber as a major competitor. Surprising number of taxi drivers get injured in car accidents, probably because they're on the road more than most other folk. But the level of earnings that a taxi driver can earn now, depending on how they source their work, whether they're actually participating in the Uber share finding system that exists for taxi drivers, or whether they're just sourcing their fares in the traditional way, it's something that can have a big impact on what the level of earnings for a taxi driver might be going forward.
And the next tip is just in relation to workers' compensation benefits and the refundable nature of those benefits. And it's important to, obviously, when you're looking at the actual earnings of a claimant subsequent to their injury, to deduct from that amount the value of the workers' compensation such that that amount can be refunded. And we include the Fox and Wood component of the the income tax payable on that workers' compensation benefit in assessing the loss.
So that's really a broad discussion around what people earn. The other part of the calculation of what people might have lost as a result of not being able to earn is what expenses might have been saved as a result of not having to go to work. And the problem arises once again because the income tax provisions allow workers to deduct certain amounts that don't always match up with the actual cost that attaches to the deduction that's made. So a very good example of that is if someone uses their motor vehicle for work and the tax office says, look, if your vehicle is over this many cc's in size, you can claim 66 cents a kilometre for every kilometre travelled. Now that vehicle may be a vehicle that's used for private purposes as well and would have been owned whether or not the person had the job for which they're claiming the deduction, because most times it's 5,000 kilometres a year that might be claimed, and the car may travel 30,000 kilometres in the same year. So what the deduction allows is you to claim a portion of all the costs associated with the vehicle. So some analysis has been done that says across the total ownership of a vehicle, for every kilometre travelled based on a certain number of kilometres as being a standard, 66 cents is about right. But in reality, the only cost that is saved as a result of not having to drive the vehicle for work are the variable costs, which are the fuel, the tyres, and to some degree the non-scheduled repair costs. So that might be closer to 20 cents a kilometre. So straight away you've got 20 cents versus 65 cents or 66 cents. So for every deduction of motor vehicle expenses, the actual cost attaching to it is probably a third of the cost that's been claimed as a deduction. So in situations where those costs are high, it can be worth spending some time trying to get an idea of what the actual costs are rather than what those are that have been allowed under the Income Tax Assessment Act.
The final tip is in relation to superannuation. It generally seems that there's a broad brush approach to that, in that the statutory rate is applied to the loss in coming up with what the superannuation component of the claim is. When we undertake our assessments, we look at what is the actual superannuation component relating to that person's earnings. So we look at who the employer is, what the industry is, and we tend to find that there's a lot of players, particularly public service, that have a better superannuation outcome for their employees. Sometimes quite significantly higher, sometimes twice. In addition to that, there are obviously different types of funds. So we generally see accumulation funds, but there are defined benefits which require, they're not able to be calculated based on a simple application of a percentage to the earnings. So it becomes a bit trickier in that sense. They tend to have a larger benefit to the employee as well.
So the real tip there is to understand what type of superannuation is being provided. Now, the law, as it applies in various jurisdictions, requires you to look at the level of contribution that applies under a written law. Now, the written law isn't only the Superannuation Guarantee Administration Act that provides for the current 9.5%. You can, in circumstances where there is an Act of Parliament that deals with the level of superannuation support provided to public sector employees, that can be up to sort of 15 or 16% of their earnings, you're able to apply that percentage to the calculation of loss of super and still adopt the prescribed calculation under the Act. Right, so that wraps us up in terms of the employed claimants, and that's broadly the things you need to look out for. The next part of it's the stuff we get involved in much more commonly. It's in relation to self-employed claimants, and really the first point in the slide there is to make sure that you really understand that you have the financial results for the entities that are involved. Now, a number of times we've started to do some work on a file and then notice the name of another company that hasn't been provided. So as a starting point, you should ask your claimant, or if you are working for the insurer, ask for all documents relating to all business structures that the person conducts their business through.
The second tip is to really consider what's happened as a result of the injury. So has there been a reduction in the overall gross income of a business that has flowed through to be a loss of gross profit? Is it the instruction from the claimant that they have required additional labour or replacement labour in the business? And who are those people that have replaced them, and what have they been paid. Another one that we see quite regularly is this idea, particularly in smaller businesses, that there's been some gratuitous assistance provided, either by family members or other employees who've perhaps gone the extra yard, and there is a judgment in the matter of Claimant and backer that seems to allow for gratuitous labour to be claimed in some instances. We also consider capital losses. Is it the instruction from the claimant that, as a result of the need to, say, sell a business, that they did so because they felt forced to at a lower sale value than they would have expected had they not been injured?
So they're all sort of losses that arise in a more unusual sense. Loss of gross profit is probably something you wouldn't be directly familiar with. What it recognises is that businesses that suffer a financial detriment don't always finish. So some of the expenses that allow the business to continue, the fixed type expenses, the rent and lease costs and finance costs remain in place. So it's really only the loss at the top line, less those directly variable costs, that is the difference in that business. So sometimes you can have a loss of gross profit that actually exceeds the total net profit of a business. So just need to be aware of getting an idea or a detailed statement from your client as to exactly what has happened as a result of the impact on their business of their injury. Now, replacement labour that Kain touched upon, I'd urge you to get a detailed statement from both the claimant and those people who provided the labour, just to fortify that case in relation to what was actually done, what was previously done by the claimant that's now being done by the replacement labour. Now, sometimes that replacement labour is actually results in a benefit to the business in total, because it allows a claimant who was previously spending more than the ideal amount of labour for a business owner on the tools. So he's able to step back from that, provide a reduced level of work actively in the business, and actually manage the business in a more efficient way, and that can oftentimes lead to a financial benefit. So that's something to bear in mind. The other thing is that you've got businesses that exist within different life cycles. You've got businesses that just start now. I've heard just about every business that was going to start, and that's very difficult to project what that business might have earned if someone says, well, but for this accident, I'd planned to start a cafe and I'd planned to do all these other things. Now, that's problematic because you don't have any historical information upon which to base an assessment of what that business might have earned. But in other circumstances, you've got a business that's been in operation for a much longer period of time and is in a stable life cycle, and it might have all the records you need. It might have established earnings history. And then the next point becomes the issue. What was that industry one of the industries that is declining due to changes in technology or changes in the way that other competitors are acting? So you need to have an understanding from your client, or if you are acting for an insurer, try and get an understanding from industry data as to what's happening in that industry. And that sort of leads into the next question there. Are the historical trading results indicative of what future earnings might be in that particular business?
We touched on industry-specific issues previously in relation to employed claimants, and the same sort of problems exist really in looking at self-employed losses. It's important for us to look at benchmarks and try to benchmark a business to the wider industry, and we can, I guess, get rid of some of those issues by doing that, and considering trends across multiple years historical data to try and normalise financial records and financial results over a longer period of time.
So you can have a situation where you've got a claimant who's come along and said, look, for the last 5 years I've earned $50,000 profit out of my business, and turnover was $200,000, and then the next year their profit goes to $150,000, and you think, well, how can there possibly be a loss in relation to that business? It might be that in the subsequent years it reduces to $30,000, and you'd say at that point there is a demonstrative loss of profit. It really is the 150 in the year after the accident that troubles everyone. And it may be as simple as that business had a significant contract or was taking advantage of particular circumstances that existed at the time of the accident that would have existed in any event. And it might be that the 150 really is what would have been done in any event, and there may actually be no loss during that period because of specific circumstances, and the loss may then start after that point, or it might be that the 150 that was made during that period of time should have actually been better than that. So the fact that profits increase subsequent to an accident is not conclusive that no loss has been suffered in that business. It might be certainly appealing on the face of it to arrive at that proposition, but without a real understanding of what's driven that profitability, I don't think such broad conclusions should be drawn.
The next tip is probably one of the most important ones, and it's probably the first thing that we look at in reviewing the earnings of self-employed claimants, and that's the determination of true profit. What's the true profit of the business? Because like employed claimants, generally the financial records don't give the full picture. So there's a few items listed out on this slide detailing the sorts of things that we look out for when we're trying to come from the reported profit to the true profit. First one, goods for own use. You'll tend to see that in restaurants, cafes, takeaway operations. Goods for own use, it's an adjustment to recognise the private use of trading stock. So the ATO releases a determination each year of what should be added back to the trading results in terms of income to take account of what was taken by the owner for their own use. So, for example, at the end of the day, someone in a takeaway store may take on what's left in the hot box and use it for their family's dinner. So the goods for own use adjustment makes an allowance for that. Related party transactions, so that's payments to the owners of the business in the form of salaries, superannuation, directors' fees. Prepayments, we're talking about things like rent, where you may actually prepay your rent for the following year, so you actually incur the expense in one year, but it may actually relate to the following financial year. Discretionary and non-core expenses are talking about donations, fines, those things that don't really need to be incurred and don't relate to the ordinary operations of the business. Income protection payments, we deduct those from, we add back the expense to the financial records on the basis that protecting the income is not the same as deriving the income, or cost of deriving the income. Stock valuations relate to holding or trading stock at the end of the year, and depreciation costs.
So, just before we jump in a bit of an example, the fundamental proposition here is that over the last 40 or so years, that the ATO and the legislature have introduced rules that relate to the calculation of taxable income that don't necessarily match the calculation of what profit is. And a number of those items there that Kain spoke about are exactly on that point. So, to take a very obvious one, the valuation of trading stock. The ATO allows general businesses to value stock in a number of different ways, one based on cost, one based on realisable value. So those two of themselves can result in two different calculations of profit in any particular year, because to value something at its cost defers the creation of the profit until when the actual item of product is sold. So you can leave the widget in your books at $10, even though it's going to sell for $30 in a year's time, whereas the realisable value concept allows you to value your stock at $30 in the particular year. So it's a way that accountants are able to move profit between years based on trading stock valuations. Now, the reason for that is that over time, particularly in the primary production sector, where there are industries that have big increases in profitability and suffer big losses in other years, the tax office is sought to allow you to smooth those profits over various periods. So if you are unfortunate enough to see a farming set of accounts, you'll see that a sheep, when it's born, will be valued at $10. That same sheep in a year's time will be worth $200, having fed it $3 worth of grass. So it allows the $190 odd worth of profit to be deferred until you actually sell the sheep. So while you might think that no farmer's ever made a profit, the value of all their profits over a period of time may, in fact, be captured within the value of their herd. And subject to the fluctuation in prices, the farmers will usually take the opportunity to maximise that profit when the sale prices are high.
Now the next slide sort of runs through all of those points about what can be adjusted, or what can be used to adjust the reported financial records to a true profit. So if we run down, so we add back $10,000, or we add $10,000 to the gross income, this would be the goods for end use adjustment, if you like. Going down to the no adjustment to materials, the next line item, salaries and superannuation paid to directors. We take out those expenses on the basis that we assume they're not an actual expense to the business, they're just a distribution of profit above the line. We make an adjustment for rent here to take out the value of the prepayment. We take off the donations and fines expense on the basis that, as we mentioned, they're non-core operating expenses. There's an adjustment to the income protection insurance, an adjustment to depreciation to recognise the idea of accelerated depreciation. And all in all, we go from a reported net profit of around $120,000 to a true profit of $300,000 with those few adjustments.
So every case is not that extreme. There is generally, in every case, we see an adjustment that needs to be made. Now it can be $5,000, $10,000, but they of themselves are $100 a week or $200 a week when you're looking at a long-term loss of earnings. So it's just the fundamental point would be that if you look at a set of tax records, tax returns for an individual or a company, and they've got a business schedule in them, to simply accept the fact that that business schedule reflects the reality of the person's earnings is at its best unlikely, and at its worst very risky on your part.
Next one, timing issues. So what we're talking about here is giving some consideration to the fact that income and expenses may not match, or there may be this idea that income was received subsequent to the injury that actually relates to work done prior. As I mentioned earlier, people like real estate agents tend to have this lag in undertaking the work between the date that they undertake the work and the receipt of the income. So it may be that there's an initial post-accident spike in income that actually relates to prior to the injury. So it's just having that understanding of why is income coming after if someone said that they have not worked. There's likely a reason for that.
So that, in addition to people like real estate agents, you can have people who are operating small businesses whose income is recorded on a cash basis. So when they receive their income, they're required to report it for taxation. So if they've got some clients who haven't paid them for 2 or 3 months, and they choose to pay them straight after their accident, you'll see income reported in their business activity statements at a level that you wouldn't expect if their story about their inability to work was correct. You need to then go back to these people and say, well, really, when did you derive that income? Not when you received it. That's the important issue in terms of assessing someone's reduction in earning capacity. The last point there on that table, seasonality is a very interesting one. You could have a courier driver, for instance, who gets injured in October and is able to work at 50% of his capacity for the next 6 months or so. The 3 months leading up to December are traditionally the most advantageous to work as a courier driver, as Christmas presents are delivered to various people. So you may see that their income on a quarterly basis doesn't decrease in the next quarter as compared to the quarter before. You then need to go back, and they're still saying to you that I could only work half my time. Go back to last year's business activity statements and look and see if there was any seasonality in the quarterly reporting of income.
Nextly, just looking at the impact of economic and political factors. Obviously, the GFC has had a big impact on financial records in the last 10 years or so, particularly in construction. I mean, Mark mentioned earlier the mining industry and general resource industry and how they've fluctuated over the years, and they really are obviously a cyclical industry. Thinking about legislative changes, we're waiting for it to happen up here, but pool fencing laws in Queensland have changed recently. I'd imagine there's been a spike in the earnings for people working in that sort of industry. Home insulation program was another one where people made a quick buck for a short period of time. And thinking about the economic outlook in certain industries.
Certainly the experience with the introduction of the GST in 2000 is able to guide us as to what might happen should the government of the day choose to increase the GST again. There was a big bring forward of expenditures to the quarter before the introduction of the GST as people sought to avoid having to pay it. And I would expect to see a similar type increase in activity in certain industries if, in fact, the belief was that GST was going to increase, because in sectors like house construction, the addition of another 5% on top of the total construction cost is a sizable amount, and people will actively choose to sometimes make payment in advance to take advantage of those reduced prices. The next point here is return on capital, which is something that's quite often missed in these types of cases. You may have a situation where a person is in a business that has a sale value. So I work in my business, it might be a Subway franchise. And I work in there and I make $200,000 a year, and I provide labour and I provide management expertise in the operation of the business. I get hurt and I have to sell my business. Now, I sell the business and I get $500,000 for the business. So previously I was earning $200,000 a year, so on the face of it the argument is, well, but for my injury I would have earned a similar amount going forward. Now I can't work anymore, but I will be able to replace part of the earnings I got from the operation of the Subway business by investing the capital proceeds in some other investment venture. Now it might be that I can get a similar rate of return as I could get in a Subway business, or it might be this idea that capital that's employed alongside the efforts and expertise of an owner is able to generate a higher level of return because of the manner in which the owner who actively works in the business is able to manage the risk associated with that business. Now, it's a very complicated argument, and it rests upon the fundamental proposition that a long-standing owner in a business better understands the risks than someone who's walking in from the outside and has to assess those risks without the benefit of the long period of ownership. So there is an argument that you can recover for some of the loss of return on capital that sits alongside your efforts and labour in a business. And the last point there is, sorry, as an adjunct to that, I will say this, that if you have a claimant who is actively in the business of setting up businesses and then selling them for profit, say a number of cases involving small supermarket owners who establish a site, they set up their business, get stock in place, and for 5 years they make an increasing level of profit. So across that 5 years they might have averaged $30,000 a year profit, when in the last year they were earning $50,000 a year. But in historical terms, that's what they do, and then they sell that business for, say, $200,000 a year to someone else who then operates as an established business. In that circumstance, what I would say is that the earning capacity of the person who does that is measured by the average profits over the period of 5 years, plus the value of the capital gain that was generated by their efforts and expertise during that same period. Now, that capital gain may be taxed at a much more advantageous way than what their income would be. Just something to be aware of. Now, the very last point, superannuation. Most times, self-employed people aren't entitled to loss of superannuation, and really, all that can be taken into account there is the fact that if they were making contributions to superannuation out of the profits of their business, then some recognition can be given to the fact that part of their profits will be taxed in a much more advantageous way than what the earnings will be. So instead of paying 40 cents in the dollar on normal earnings, someone who diverts the maximum amount to their superannuation fund may be entitled to have that part of their earnings, up to $35,000 a year, taxed at 15%. So it will simply affect the level of overall tax payable. So that wraps up what we wanted to speak to you today about. Hopefully this will be the first in a series of these. We do these presentations as in-house offerings as well. So if you do have any questions to us about what we've spoken today, feel free to call us, feel free to email us, or equally feel free to approach us to come and do an in-house presentation.
Thanks, everyone.
Thanks for your time.
Cheers.